Hey traders, I think we're good to go. Welcome to the Friday pre-market show. All right, so the text that's up there, by the way, you can text me your questions. And clearly, if you're in the room here, feel free to type in whatever questions you might have. But if you're catching this on replay, feel free to text me your questions. And we're live from 9 to 9:20. So let's get to it. All right. Good morning. Good morning. Good to see everybody. So let's talk about a few things here. You know, I do sessions in the options futures room and here in the pre-market, and sometimes I forget the overlap. So if I've already covered this, please feel free to tell me. But I think this is pretty important, and I'm going to put this graphic up here right now. All right. So right here, you've got a graphic that I found on the internet. It does jive with what I have found anecdotally trading through elections for many, many elections. So notice here that there are two peaks on this chart. How many of you have seen this chart before? I'm sure some of you might have. All right, so if you have seen this chart before, well, then you know why the markets are rallying. They're rallying because what we have right now is the expectation for this column right here, split Congress, Democratic president, okay? It's never about politics. It's about tendencies. It's about history. Notice this is the annualized calendar year price return since 1945. So these are the tendencies that we've had throughout the years. There's only one other column that does a little bit better than the column that it seems we're heading into, and that is a unified Republican government. So since we have the split Congress, it seems, and Democratic president, again, it seems, the markets are rallying because the tendencies in history tell it that that's the most likely scenario. So pretty reasonable as to why we're rallying. The other thing to keep in mind was yesterday, let me bring this up here. Yesterday we had Jerome Powell. And here we go. So basically, poked myself. All right, there we go. So here we have a Thursday, which is unusual. We have a Thursday FOMC. Gang, that means Wednesday and into 2 p.m. on Thursday, you really don't want to be short. We focused on this Wednesday. We focused on this in the chat room, in the futures chat room on Thursday. And I'll talk more about it in both the options and futures room. So if you're in either room, I'll see you all today at noon. All right. So we don't want to be short in front of Powell. How long in front of Powell? I'll typically be cautious of the week since he typically is speaking and the statements come out on Wednesday. But this time with it being Thursday, I started focusing Tuesday, but definitely the day before. So think of it as the session before and the session of right up until the press conference begins, or even right up until the statement. But typically the press conference is where the volatility kicks in. But as a general rule, we don't want to be short into Powell. Now, a lot of times people will short right at sort of the peak in terms of time. Peak meaning they'll start to look to build short positions into 2 p.m. Eastern. But that's very different than saying let's not short before that. All right. So you add the tendency, you add that Jerome Powell event on Thursday, it makes sense why Wednesday and Thursday have been as bullish as they are. Would I expect the market to take a little bit of a breather? Let's take a look at what we've got right now in terms of the intraday. Now, at this point of the morning, let's think about day trading. At this point of the morning, what I'm looking at is really twofold. I want to know where we are in relation to yesterday's close. So one way to really do that quite easily is just scrunch this up. I know it doesn't look very useful, but all I'm curious about is where the 4 p.m. close was. So where was 4 p.m.? Okay, roughly there. Would I consider that a gap? No. So no gap psychology in the Dow. So the gap psychology is twofold. We've got to be above or below the close. That's the more generic, the general, I'll say the more popular way of measuring a gap. What I like to do is being above both the close and the high of the day, or being below the close and the low of the day. So we're not meeting that criteria at all. So we do this across each one of the broader indices. Hey there, good morning, good morning. Yes, it is Friday. It's Friday. Matt, it is a very interesting chart, right? It takes the politics out of our analysis, right? I mean, that's what we want to do. We want to take the politics out of the analysis, and it injects tendencies. It injects psychology, which is what we're really after. Okay, so let's see here. I'm going to move the chat window over to another window on the screen here. Okay. There we go. So let's do the same thing with the NAS. Where was the 4 p.m.? There is right there. And again, notice I'm not getting really like right on the money specific. Where were we in the close? What about there? I mean, do we have gap psychology? No. Again, gap psychology has got to be, in this case, I want it to be below the close and below the low. And you might say, well, Rag, it looks like we're kind of close on that in the NAS. But remember, our low is way down here. So again, I want both criteria met. The more that those two criteria are met, it's generally called, I've seen it called a true gap. You can call it a ham sandwich. I think we get very hung up on lingo. We need lingo because we need to know that this word means, this to the market behavior. So when I talk about gaps or true gaps, I'm referring to that criteria where both those levels have been taken out. And once again, we're just not seeing that to be the case. So that means that I'm not looking to fade anything on the open. I need a true gap, that criteria to be met to justify, to validate doing something right on the open with the first 5-minute high-low. Same thing with the RTY, close to the highs, but not a gap. Now, oftentimes what I'll do is I'll look at the end of day chart. And by the way, the same thing applies to stocks, ETFs, as it does the futures market. So if I'm looking at the ES right now, let's take a look at the daily time frame of the ES. All right, so if I look at the daily ES, I mean, right now you can see today's candle right now is, we don't know where we'll be at 4 p.m., but right now at 9:08, the current range is an inside day. What does that mean? Let me show you what I mean by that. Here's the top of your range. Here's the bottom of your range. And as long as this current candle, this candle right here for the 6th of November, remains within the high and low of yesterday's session, inside day. It's also known as a harami for those of you that are fans of Japanese candlesticks. That's a harami pattern. All right, so we have, I wish I would have seen that before. The position that I had in front of the election, to your point, Matt, the positions that I had in front of the election were long gold, long utilities, transports, really just kind of more of an infrastructure leaning within those, kind of an infrastructure look. And hey there, AJ. So gold was a long position, and gold, what we want in front of major events like an election is what I was calling an election honey badger. In other words, we want something that's really has no bias to who's in the White House or not. Energy is not that way. I'm not playing healthcare. I'm not playing financials. Energy, XLE, healthcare, XLV, financials, XLF. Don't want anything to do with them right now. Gold, long. Dollar, short. Long infrastructure, which is again like a hodgepodge of XLI, IYT, XLU. Are there, by the way, let me zoom in. You guys don't need to look at my face. There we go. Let's talk about where we are in terms of the November to December trend. Look, I think we pretty much know what's going to happen from a political standpoint. It's just a matter of letting this play through, I guess, through the courts. But I think the market's going to continue to be pretty content rallying. So that means that we want to continue to be vigilant about focusing on the relative outperforming sectors and then the relative outperforming stocks within those sectors. We can say the same thing about the indices, relative outperforming stocks within the indices. We want to continue to focus on that. And that's really going to be how we move forward into the remainder of the year. Now, for those of you that may not know, today at 4:30, we're going to start the tech session for my class at 1 p.m. tomorrow. So the educational class starts at 1 p.m. tomorrow. The tech session starts at 4:30 p.m. Eastern today. And that's all on ETFs, trading options on ETFs, building your watch list in this way that I've created for myself using this psychology of ETFs. And what do I mean by psychology of ETFs? Gang, ETFs absolutely impact individual stocks because of the weighting of the stocks in the ETFs and the volume of the ETFs. And this is really this isn't something that's been going on for decades, not really. It's been going on for about 12 years. It's pretty new. 2008 began the ascension of popularity of the electronic traded fund, the ETF. And the stocks that are weighted within them are behaving in a way that they really didn't before, because we've basically taken all these stocks, we put them in a group, put them within an ETF. When that ETF moves up and down, it influences the stock. The stock can influence the ETF as well, by the way. That's the tail wagging the dog. But ETFs have become more important than ever. And then what's really great about ETFs, and a lot of you might know this when you look at the options chain, the actual cost for trading options on ETFs oftentimes is far less than the cost of trading some of the underlying stocks. A great example is trading XLY when Amazon is tracking with it. And I'll use XLY as a proxy for Amazon. So there's a lot of ways we can do that. If the thought is to be bearish on the dollar, I am. By extrapolation, does that suggest that equities, not all metals and crypto, will have a bullish tone by default? AJ, you bring up what that question is, and that's a terrific question. What that question really asks is, what is the correlation? What's the correlation right now of dollar and gold? It's typically inverse, but it doesn't have to be. And correlations by percentage will increase and decrease. But as a general rule, right, like you said, extrapolating for a more general guideline. What would that mean? Typically, yes, dollar, gold are going to move inverse. You're going to have dollar weakness and Bitcoin strength. Again, typically, yes. Yes, sort of by default. I like the way you phrased that. You got it. I agree with that wholeheartedly. We want to be aware of the correlations right now. Let me take a look here. You can look at correlations, and this is not difficult. And you can look at whether or not they're really synced up or not. Where's my gold? This font is very small. All right, let's see. We had copper, crude. There we go. Gold. There's my dollar, DX. So there you go. You have a 75% inverse correlation or negative correlation. So it's pretty good. It's pretty good. The higher the number, the better. The negative means it's inverse, meaning one goes up, the other goes down. If it's a positive number, that means they're positively or sympathetically correlated. So you can look at data like that and get an idea of whether or not there is that synergy. Sure. Okay, hope that helps. Excellent. Hey there, Raghee. Oh gosh, tell Bridget I said hey. Looking forward to seeing you in the class tomorrow. Oh, awesome. All right, so let's, so CLOU is, so the reason I have this CLOU ETF, this layout, by the way, I know at first it's a lot. It's like, whoa, Rog, turn down the volume on that one. But remember, what we're looking at is the relationship between the individual stocks to the broader sector in this case. And I think CLOU has been a pretty good sector to keep an eye on, not quite as good as the SMH has been. And then SMH has not been quite as good as the XLU, but SMH has been solid. Take a look. So at the first pass, and this is a big part of what we'll be talking about in the class tomorrow, the first pass on this layout, which I just call the multi-chart because I'm really awful at naming things. But the first pass, you'll notice the broader sector is what we call double green. Good bullish, very good bullish organization of the 8, 13, 21, and 34 EMAs. So that's a expectation for higher highs. TSM's the same way, Qualcomm's the same way, LRCX, Texan, TXN, Texas Instruments, NXPI. We have relative outperformance here in individual stocks. We have a very good structure on the broader index. Again, this is where you keep your eye on for opportunity. Now, if I take a look, let's do the same thing with the SPY. Take a look at the S&P. What does that look like? A lot of Apple, a lot of Microsoft, very XLK ETF there, Google, but not as good, is it? Not as good. This is what I mean about in a choppy market, which we are in right now, broadly speaking. When you take a look at the S&P, the NASDAQ, the Dow, these are choppy markets right now. And even though we've bounced from an oversold to now closing in on an overbought level, respecting the trend that would keep us with this bullish bias. These are some of the very simple but tried and true philosophies, guidelines that I adhere to unwaveringly. And so there's no reason to think the market's just going to roll over and put in a V top or even a W. The W right now, this W back and forth pattern, or M, whatever you want to call it, that's just distribution. That's chop. In chop, you don't want to bet on the bigger picture indices. You want to get a little bit more granular, starting with the sectors, and then you want to get even more granular still, getting down to the individual stocks. So people talk about a stock pickers market. Gang, a stock pickers market is typically going to be a choppy market. You really don't want to be an individual stock picker in an overall double green or double red downtrend. You want to bet on everything, or as we joked during June, July, August, and some of September, buy all the things, right? Or short all the things. In a clear trend, you want to go broad. In a choppy market, you need to get a little bit more focused, a little bit more narrow. So partly what I'm going to continue to advocate here is remember that we're in distribution on the broader markets, as you can see here, and keep the individual sectors that are outperforming, preferably ones that are not sensitive to this current election wait and see game. I would not play the likes of XLE right now. I would steer clear of natural gas right now. By the way, what I would love to have done is short XLE. I might still do this. I've shorted XLE in the past. I didn't want to necessarily short XLE going into the presidential election because who's in the White House? I think this is not an agnostic sector. XLE does care who's in the White House. XLE does care whether or not we have a split Congress. So this is where I'll say that it makes sense to, in certain places like XLE and XLV and XLF, just stay cautious. But now that we've got a better idea, I'm very tempted to look at that 30 area on XLE for a short, but look at all the red across the individual stocks. This is a downtrend. I'm better off betting on the broader narrative. I'm better off betting on the tide, not the individual boats. See how this is distinctly different from the way S&P is behaving right now. So keep that in mind. Where do I think the dollar yen is going to bottom out? Asks Lewis. Where do I think the dollar yen is going to bottom out? Well, if we're looking at dollar yen, I'm just going to go the futures chart just for a moment. Just remember that the dollar yen futures is pretty much the same thing as what you'd look at on the Forex, but it's upside down because the yen is the first currency in the pair, if you want to think of it that way on the future side. So it's going to move opposite. So whether we're talking about where is the strength in the yen going to stop right? That's really the question. Or where is the weakness in the dollar going to stop? The interesting thing about pairs trading is that you can get a US dollar weak narrative continuing to keep this market moving up. Now, if the equities markets continue to chop, we might continue to see yen strength. But if the equity markets start to really pick a direction, which I think they will, yen's probably going to weaken. So, Lewis, where I think we lose the edge in the contrast between the dollar and the Japanese yen, between the US dollar and the Japanese yen, I think where we lose our edge is when the yen stops strengthening. Yes, the dollar, I believe, will remain weak, but why not look at a currency then where we have US dollar weakness contrasted with strength on the other side? New Zealand dollar comes to mind, even Canadian dollar or British pound comes to mind, or even euro. But I think the yen is going to be much more susceptible to the strength in the equity markets. And if that really does, I think, gain traction as we get past this uncertainty of this, counting the ballots window we're in, yen could weaken. I would keep an eye on that one. So I like where your head's at. I like the short dollar, long yen for now. It may not last long if the stock market continues up. So look for where you can play weak US dollar against a stronger currency. And that's where I go to the 6N or the New Zealand dollar, US dollar, my friend. Yeah. All right. So that concludes our show, gang. I try to run the show about 9 to 9:20. That way you guys can go to your respective rooms, whether that be the simpler options room, whether that be the simpler futures room. Both those rooms are now underway. And I'm going to log off here and get to work. I'm looking forward to seeing you all for tomorrow's class. If you haven't checked out what we're doing, you can head on over to simplertrading.com/ETF. And for those of you that are members, I'll see you all at noon in both the options and the futures room. We'll talk more about some of these topics like the watch list that I'm looking at, and as well as what this market's digesting on a non-farm payroll Friday. I mean, does anyone even care that it's non-farm payroll Friday? Right now, all the other narratives are getting pushed to the background because of the ongoing ballot counting. So let's see if next week sort of brings a little bit more normalcy and we can get to work. I am very optimistic about November. Thank you as always for joining me, gang. Leave a comment, leave a message, leave a question. If you have it, let me know what questions you might have. We'll tackle them in upcoming episodes, okay? This show is going to go daily starting next week. I was kind of on the fence, but yeah, we're going to go daily as of next week, and we'll be broadcasting Monday through Friday, 9 to 9:20 before the respective rooms open, before the bell. All right, gang, have a great weekend. Have a great rest of the day. Don't overtrade on a Friday. Please, gang, don't overtrade on a Friday. We've got plenty more of the month to come, and have a great one. All right, be good to each other, gang.